Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, have a beautiful retirement. I am one of your co-hosts, Ben Barzideh. I have my esteemed, trusted co-host, Matt Nadeau, here with me.
Hey, everyone.
And we are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here in Barrington. And of course, we are fiduciaries. And as an independent, family-owned firm, we truly have the freedom to focus solely on your interests and not some corporations or those shady private equity companies that are buying everything up these days.
Stay out of our good businesses, private equities.
Yeah,
right.
We don't like you guys. Don't listen
We
to our
don't
show
like
either.
it. That's right. Of course, we're going to just take a minute. If you're out there, one of our clients, faithful listeners, we're just going to take a moment and say hi to you all. You know, we appreciate you all, and especially our clients. Thank you for the trust you place in us, and we love every one of you. And we have a great show today. We've got a really interesting topic we want to talk about first because we've seen a good rally the past few years in the markets. We've talked a lot about there may be a transition to new opportunities. And we're going to talk about what we think is a massive opportunity in small caps. So don't go away. We're going to talk about what that means, what they are, how to take advantage. And then later in the show, we're going to have a very special guest. We have a mortgage professional that we really trust. His name's John Kambs. He's going to join us. He's going to talk about mortgage rates and some interest rate stuff. You don't want to miss that.
No doubt. We're going to have such a good show. But before we start, we encourage you to subscribe, like and subscribe to our YouTube channel, moneyhourradio.com, where you can view this week's episode along with the previous ones. Also, please subscribe to our weekly economic newsletter that's called the 5-Minute Market Brief. It's informative, succinct, easy to read. You get a really good idea of what we're seeing and what we're thinking. You can sign up for that at bnwealth.com. And while you're on bnwealth.com, please follow our social media pages on Facebook and Instagram.
All right. Let's get into our topic today. And we really want to talk about one thing in particular, massive opportunity in small caps. But I got to get something out there, Ben. I got to confess something right away. Got to get it in the open. You know, we love small caps. And if loving small caps is wrong, then I don't want to be right.
I love that.
I mean, it's not Valentine's Day yet, but I'm going to ask small cap to be my Valentine, maybe. Listen, here's the thing. There may be an underdog moment here. Small cap stocks are really the underdogs of the investment world. They're like those tiny, okay, I'm not a dog guy, but those rat dogs that are super annoying, like chihuahuas or whatever. They're barking like they're perpetually mad, trying to get your attention, like, hey, I'm over here.
Well, guess what? Over the last few years, they've been forced to watch investors keep tossing treats to the Great Danes of the market, the big dogs that get all the attention when they enter the room. Woof, 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 woof. And I'm talking about the mega cap tech giants of the S&P 500. Hey, the big dog eats first, right? I have a big 95-pound European boxer. When he walks into a room, it's pretty impressive. Well, on that note, we suggest that you take a minute and look down at those little dogs that are yapping at your feet and biting your ankles. It just might be their time to shine and reward you with treats. And you know what treats we're talking about? The green ones with pictures of previous presidents on them. The Benjamins.
The Benjamins. All right. We'll go with the non-president, the Benjamins. So I guess there's people out there that are wondering, like, what do you mean? What's a small cap company? So, you know, generally, first of all, when you hear about the stock market, most people are just talking about like the S&P 500, the big 500 giant companies that are out there. Well, small cap are the smaller ones that are generally considered if they have an overall market cap that's worth between $250 million upwards to about $2 billion. So they're small enough that you probably wouldn't even recognize the names of most of them. So then the next tier as they get bigger are like mid-cap companies. Now we're getting to that $2 billion to $10 billion range. An example would be like a Harley Davidson. They're not one of the biggest, but they're big enough you've heard of them. And then the large companies, well, those are the ones you've heard of. They're usually start at $10 billion. And if you get up there into the trillions, we're talking about the mega, magnificent seven. So now we kind of laid out those where they fall. Why are we excited about this small segment, these small caps? And why do we think they are potentially a really good buy right now? So I'm going to go through some reasons. Ben, I'm going to take the first reason, which is they've already started to pick up steam. They've got a trend going. So over the past few months, large caps in tech, they've just mostly gone sideways. Really, not because of anything bad. Maybe they're just taking a breather. But small caps have now started to outpace them in performance over the last few months.
Number two, small caps are actually a relative bargain right now compared to the large caps. So if you look at what we consider the forward price to earning ratios of the Russell 2000 index, for instance, that's the small cap index, versus the S&P 500 index, which is the large caps. But if you look at their forward PE ratios, you'll see that large caps are trading at a 24 forward PE ratio, while small caps are at an attractive 18 forward PE ratio. So very reasonably priced, historically undervalued. And then number three, they may have some good runway left in order to catch up to the large caps. And here's what we mean. Since January of 2022, which was the top of the market before we went into that bear market crash that happened that year, large caps, as measured by the S&P 500, well, they recovered all of those 2022 losses by about January of 2024. So after 2 years, you were back whole. But since then, they're up about 45% over the last 2 years. Small caps, on the other hand, the recovery has been much slower. In fact, they just got back to the 2022 high just a few weeks ago. And they're only up about 10% now from that high. So basically, that means there's about a 35% spread that small caps are underperforming large caps by since then. So if they start playing catch up, there's a lot of room left.
Yeah, and usually small caps, when you come out of a bear market, are the gangbusters that lead the way by a dramatic amount. So they've got a lot of catching up to do.
Absolutely.
And what may help them catch up and maybe even continue going is this economic environment may actually now be turning more in their favor. So small caps are definitely more sensitive to economic conditions and interest rates. So when the Fed had to raise rates in 2022, small caps got hit harder than large caps. And since the cutting cycle over the past 2 years or so, now the tides are starting to change. And if the Fed does cut rates some more this upcoming year, it could continue to support the positive environment for them. So really the question is, could this be the year where small caps get back on track and lead the bull market? And we think they could. So for now, we love what we're seeing and are especially high on small cap, especially the small cap value and the blend areas. Now, the growth area, it's continued to underwhelm in this value over growth environment of the past few months. You never know, that may change as well in the future too. But since we like them, guess what? Another confession I got to make, Ben, for our radio listeners to know. We've got them in our starting lineup in our Advance and Protect tactical investment strategy that we manage for our clients.
And we are very bullish right now. We have not taken our foot off the gas over the last few months. We are 100% involved in equities and have been for a long time now. We have gold, silver, copper, Magnificent Seven Sleeve. We had a fantastic year last year of making money for our clients in 2025 and are off to a great start so far in 2026. And guess what? We don't just buy or invest a little bit into everything. We intelligently diversify by investing only into the areas and asset classes that, based on our research, are gaining in momentum and strength. And we likewise avoid areas that we see are deteriorating. We won't put money in those. And as the trend changes, guess what? So does our reaction and our allocations. We are data-driven, not emotion-driven.
And along that same line, we'll watch these investments every day, and we can quickly react if it's necessary. So if market conditions deteriorate, we will do something about it. We'll get defensive and start selling out of stocks and going heavier into bonds or cash. And at times, if it gets bad enough, we'll go 100% out of the market. Now, we don't believe in riding market crashes all the way down to the bottom. And we feel in retirement, it's paramount to have a disciplined sell strategy to exit if the risk of a crash gets too high. And the best time to have one of these plans is before you need it while things are fine, not after the crash when it's too late.
So our question is, do you have a defensive plan to help protect your money from a potential market crash? We certainly think you should. And where can you find more? Well, big news. We'd like to invite you to an exclusive educational dinner workshop at a beautiful local country club on Thursday, January 29th at 6 p.m. And we're going to go over all of the major tax and estate law changes that are coming into 2026. We're going to see if your retirement plan is ready for them. Would you like to learn more while enjoying a delicious steak?
Yeah, and this is not an annuity sales pitch. It's an educational workshop designed for individuals and families approaching or in retirement who want knowledge, confidence, and practical next steps, all while enjoying a refined dining experience. So seated is limited. To reserve your spot, call 847-780-2980 or visit bnwealth.com. Don't go away. When we come back, we're going to talk with mortgage professional John Kambs. Welcome back. Thank you for tuning in. This is Money Hour Radio, a show where we try and help you grow your money, pay less taxes, and of course, have a beautiful retirement. And I'm one of your hosts, Matt Nadeau. Of course, have with me my esteemed co-host, Ben Barzideh.
Hello, everyone.
And we're actually, as you know, founding partners and wealth managers at Barzideh and Nadeau Wealth Management, comprehensive financial planning firm, independent and located right here in Barrington and serving the greater Chicagoland area. And the great news is we are super excited to have a special guest on with us this week. His name's John Kambs, who is a mortgage expert. He's actually going to share his insights to you, our listening audience, into the current mortgage and housing environment and things you should be aware of if you are looking to potentially buy a home right now. So hi, John. Thanks for joining us. And can you tell us?
Yeah, thank you guys. Thanks, Matt and Ben, for having me. Really appreciate you guys extending the offer. And my name is John Kambs. I'm a branch manager. I'm with Rate Mortgage, formerly known as Guaranteed Rate. We dropped the guaranteed because we realized nobody knows how to spell it, and it's a really long word. We are on the Sox Stadium. But yeah, I've been doing mortgages for 25 years now and run a branch here. But my bread and butter is helping people buy, sell, refinance homes with utilizing the power of a mortgage. So thank you so much for having me. I'm really excited to be here.
Absolutely. And by the way, John has a beautiful family with his wife, Jamie, their two teenage daughters, Lily and Lexi. And by the way, how we know John is he helped me and my wife with our mortgage when we bought our home in Huntley back in 2012. We had a wonderful experience with him. We have kept in touch since. He is hands down one of the best, most knowledgeable, hardworking, and ethical people we know in the mortgage industry. He treats his clients well, has an awesome reputation. So we're very excited to have him on. And John, I know we want to actually start by talking about just the general interest rate environment, the housing environment we're seeing right now into the 2026 spring home buying season. We got some questions we're going to ask you throughout this. We're going to pick your brain a little bit. But let us know what is going on right now. What's the mortgage rate? What are we seeing out there?
Yeah, so right now, mortgage rates, it's, if you're doing a conventional loan, you're looking 6% to 5.5%, depending on how you structure it. 6% would be without paying any buy down points. If you're going to get all the way down to 5.5%, you're probably going to pay a point or two, depending on your credit, your income, and your assets. And if you're doing a government loan, also known as an FHA loan, VA, USDA loan, you're going to be in the 5.75% to 5.25%. And, a lot of people are like, our rate's going to go down. When our rate's going to go down? I'm like, guys, they've come down about, you look in June last year, we were in the low sevens. So we've come down over a full point, but I think nobody's used to having 0.25% interest rates, even though they've come down a lot. But I do think that I'm forecasting, I think rates are going to be in the 5.5% to 5% range in 2026. When you look at the fact that inflation is so overstated right now, there's, the inflation has these one-time tariffs that are being calculated into it. It's also, if you look at the shelter component in PCE and CPI, there's a huge lag in it. If you look at the Cotality Rent Index, the Fed is way behind the curve on the shelter component. So I think you're going to see, and the Fed's saying PCE core is, they moved the goalpost a couple times, but for now, PCE core is what they are saying is their holy grail for inflation. And I think if that gets to 2.5 or below, you're going to see the Fed really start to ease, not be as hawkish as they've been. And obviously you have the new chairman who hasn't been announced yet, but it's pretty obvious that Trump wants to appoint a dove. And so I think that you're going to have the Federal Reserve cut. I think that the Fed funds rate is going to be 2.875 by the end of the year. And I think the 10-year treasury is going to be 3.8. And if you look what's been going on, you guys know that the spread between mortgages and the 10-year has been tightening. So if you think, if you look at like the more historical prediction of 2% spread, if we get into that like 1.9% range with inflation starting to really show signs of declining, and then you have a jobs market that is way worse than the Bureau of Labor Statistics has been putting out. I think when I think, I don't know if you guys saw the statistic, but it's like the QCEW from last quarter to this quarter. So you look at September 25 to September 24, they overstated jobs by 78%. So basically 78% of the jobs that the BLS was saying existed didn't exist. So I think you're going to see continued weakness in the labor market, which is going to drive interest rates lower and ultimately be a good thing for those that are in the market to buy. And I think it could be a good thing for people who own right now. Yeah, I think that's the basic, what I'm seeing with the interest rates. I think as we head into the spring, they're going to be in like that 5.75 range. And I think that as we get to the summer and fall, it's going to be more like in that 5.5 range without paying any points.
Well, John has said that just for our listening audience, if you say you came from us, he's going to give you an extra % off of that rate.
Yes,
so
yes.
He's going to give you the friends and family discount.
Yep, we better make sure they know that's a joke, right?
Yeah, that's a joke, by the way, folks. That's a joke.
Yeah,
we're going to disclaimer here.
Yeah, we're going to have to bring John on as our economic expert. He's covering all these other areas.
No doubt.
Fed and job numbers. We always joke about being fuzzy math.
Yeah.
John, like, I'm glad to hear you're thinking the same way as us with rates probably going to continue going down. So let's talk about like first-time buyers, if they're applying for a mortgage, what should they know if they're going to go out there and start looking?
I would say plan ahead. If you're a first-time home buyer, I recommend you getting pre-approved 120 days before you want to buy. I can fix a lot of things in 120 days. I can't fix that many things in 30 days. And oftentimes I see first-time home buyers, they were on Zillow, they found their dream home, and they want to close in 30 days. And then they have an issue, they have a down payment issue, they have a credit issue, whatever it may be. You can't fix nearly as many things in 30 days as you can in 120 days. So then I would also say that it's not as hard to buy a home as most people think. Most people think you need excellent credit, you need 20% down, you need to be clean as a whistle. And that is not the case. I like to tell people there's really 3 variables to you buying a home. And it's your credit, your down payment, and what they call your debt to income ratio. So generally speaking, if you're weak in one, but strong in 2, you're going to be okay. So if you have maybe not the best credit, but you got a decent down payment and a job that shows you can easily afford the mortgage, you're going to be okay. But if you have 2 of the 3 or 3 of the 3, then it's going to be challenging. But yeah, those are the biggest things I would say for first-time home buyers. Is it's not nearly as hard to buy a home as you think. It takes literally 20 minutes to do a digital application. We only do a soft pull on your credit report. There's no cost, there's no obligation. It's completely harmless. And it's just never been easier to get pre-approved. And we don't bite. Like, we want to help you get into a home. So there's going to be no judgment. I think like when you look at, like, I'm 49. I know, Ben, you're in your mid 40s. Matt, you look like you're probably in your 20s. But
I'm the old man of the bunch.
Okay.
He's
really?
like 2 years older than me, but I always give him the business.
Okay. Yeah, you look great for your age. But
thank you, sir.
So yeah, but we all have skeletons in our closet, right? None of us are perfect, so there's no judgment. And yeah, just get pre-approved early. And even if it does turn into like, hey, I got pre-approved, I decided I wanted to wait, no big deal. Like, so that's what I would say for first-time home buyers.
Well, how about in 1 minute, can you answer the big magic question, which is that, do you think home prices are going to crash this year? People are waiting for prices to go down before they buy.
No. If you look at like what's gone on, pending home sales have skyrocketed. I saw this the other day. I thought it was pretty funny. What about all the people that said, marry the home and date the rate? How did that work out? And when you actually look at the mortgage market, it worked. But the problem is that it worked for like in the last 3 years, like 4 or 5 days during those 3 years. So a lot of people didn't take advantage of it. But my point is, now that we've had a sustained, every other time rates have gotten this low since they went up, it's been like a 3 to 5 day window and then they're back up. But if you look at the fact that since September to now, we've had a pretty sustained lower mortgage rate environment. Refinances, they know right away, but purchases take some time for people to realize, oh, rates are down. Oh, I'm going to start looking. Oh, they've stayed down. So now that we have this 3 to 4 month period, you're seeing, I haven't been this busy in a December and in a January in a long time. And when you look at pending home sales, they're the highest they've been since the pandemic. So no, I think you're going to, now
great.
This is national, guys, right?
Yeah.
Like this is the other thing I think people have to realize is that it's a national average. Real estate is local, but I think that a crash is but far from on the table.
Got it. John, we're going to be running out of time soon, but how can people reach you? How can people get a hold of you? What's your contact information?
Yeah. So you guys, the best thing to do is to email me, and I'll give you my team email just because it's the easiest email. It's K as in Kelly, J as in John, G as in group, KJG at rate. That's R as in Robert, A as in Apple, T as in Tom, E as in Edward.com. That's the best place to email me. And if you want to text me or call me, you can reach me anytime on my direct cell. That's 773-939-1521.
All right. Thanks, John. We'll go ahead and also post that when we put it on our YouTube page, so you can see that in the description. But we are running out of time. And before we go, we have a really important announcement. For those of you who are listening, we have an upcoming dinner workshop that you're, as a listener, invited to at a local country club Thursday, January 29th at 6 p.m. And again, during this event, we're going to talk about things like market changes, rates, but also important tax and estate planning tips that have changed in 2026. You don't want to miss it. We're going to feed you a delicious steak. So give us a call to reserve your seat, 847-780-2980, or visit bnwealth.com. We're out of time. Thanks for joining us, John, and we'll see y'all next week.
Thank you guys for having me.
God bless everyone. Take care.